So therefore, like I'm suggesting to buy I bonds. The reason is I bond, I bonds are basically just a second. So Series I bond protects you from the inflation. Basically, it earns both a fixed rate of interest and a rate that changes with inflation, right? Which is perfect. So let's say if there is more inflation, the Fed is increasing the interest rate. Here as well, it is adjusted to those inflation, thereby you're protected. Your capital is protected, and you've given you're kept with the inflation. Therefore, you're not losing money. So let's say you're putting some money, you're getting that money back. So for example, as at the time of recording, the I series bond is yielding 6.89%. And the most important thing is the I bond is backed up by US Treasury, right? So it's not like some junk bond. It is issued by US government. So it has a lot of tax benefits. I'm not going into go into that. Uh, so why I bonds? So for example, if you go to their website, like their regular bonds that is issued by Treasury yields 2.1% at the time of recording, whereas the I bond is 6.89. The reason being is EE bonds, they don't they don't provide any cushion for inflation, whereas I bonds, they, depending upon the 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 inflation rates, the the rates of I bonds are adjusted accordingly. So basically you get fixed rate plus a rate a rate that changes with inflation. So that's why I would recommend, um, my pick for bond for US conservative portfolio would be I bonds. Now, mutual fund or ETFs. So the 40% is going to be invested on mutual fund or ETFs. So for that portion, I would suggest to invest either in, safest, because you're a conservative person. It is better you invest, and you have longer time horizon. So you can either invest in Vanguard's total market index fund, or swaps. This is a dividend ETFs. Either would do. Both are low cost, very cheaper to hold. um, and you can, so just to give you an idea, so this is Vanguard total stock market index. You see, for last 5 years, it's like 49%, versus Schwab's US dividend equity ETF, which is the other one I recommended. It's 56%. So you won't go bad, like you won't be in a bad situation in investing in both. Either one should be fine. Both are low cost. Yeah, so this is the two ETFs that I would suggest for the mutual fund, right? Yeah, so that's about US conservative. Now, for Canadian conservative, since I'm from Canada, I'm recommending this. In Canada, unfortunately, we don't have I bonds. But before we get into that, same principle, conservative. You're a person in Canada. You're very conservative. You don't want to lose your money, so therefore, most of your money is going to sit on bonds. It's going to be 60%, and but you still have longer time horizon, 10 years. So you put some money in mutual funds and some money in cash, just to give that cushion. I'm putting 10%, and gold 10%. I will get to why gold in a shortly. So that's the mix. In terms of picks, my picks for bonds and mutual fund, unfortunately in Canada we don't have a lot of options like US. In US you have, regular bonds as well as like I bonds. I bonds is awesome. I really like it. Unfortunately, in Canada, we don't have that. Like, we don't have a bond that can match up to inflation or whatever, right? So therefore, it is important. Like when we talk about bonds, because there is a risk due to the uh, interest rate interest rates, it is important that you find a bond that is like ultra short term, right? Because because if the maturity date is short term, your coupon rate, it is not possible for the government to increase for every 2 3 months. Maybe they will give in a given period. It is possible, but then if you think about the longer time horizon, if you hold a bonds for very very short duration and keep buying short duration bonds, your risk on interest rate is kind of is averted, right? So that's the only possibility in Canada. Otherwise, if you invest in like long-term bonds, it doesn't really make sense for Canadians. So just to give you an idea, this is that uh, TD TD is a TD TD is a Toronto Dominion Bank, one of the banks in Canada, and they offer this bond. MER is 0.45. In Canada, everything is expensive, so 0.45 is okay enough. So now coming back, like why I picked this bond is because of the historical performances. So as I said, like you want to, being a conservative, you want to conserve your portfolio, right? You don't want to lose money. So you can see like for since inception, it's not yielding longer lot of money, but at least it's preserving and it's giving some return, right? And if that is that is what is your objective, you go about investing. As I said, in Canada there is not a lot of options for bonds. So unfortunately you only have to stick with this. And for the rest of the money, because you're conservative, you're really scared about rest of the stuff, so you don't have any option but to do with this. For mutual fund, again, since you're conservative, I would suggest to invest in the you know uh, in in the Canadian index fund. So basically, you can invest either in VCN or VCE. Both track the Canadian index, and you can see the performance. Like so, this is blue and yellow are the ones that I'm recommending. You can see both pretty much track each other very closely. And the top one is the Canadian bond, which is iShares Core Canadian US Bond. You can see it's pretty much like, so. For example, year to date, iShares Core Canada US Bond is like down 10%. So that's why I'm saying like there's not like a lot of good options unless you hold a ultra short term bonds, right? You otherwise you will lose a lot of money. And then you see, but either of these ETFs will do good. Either you can invest in VCE or VCN. Both are similar, right? VCE seems to be little bit better, but not much. So if you think about long term, see, even in long term, this iShare Canada bond is down 10%, 5 years. Whereas like if you invest in these two, you're still fine. So I wanted to show you like in Canada there is not a lot of options when it comes to bond, unless you go to like some sort of like wealth management company and pay them fee, and but you are a beginner. I'm thinking you're a beginner, you don't have a lot of money at your disposal. You have some money, you just want to get started. So this is the best way to do. So you invest your money in TD Ultra. That's my pick, right? TD Ultra short term bond, and for mutual fund you do VCE and VUN. VUN is the total total. So VU VUN VUN is the Vanguard US Total Market Index ETF. So year to date, it's down 11%. But if you think about if you're investing for longest horizon, like it's going to do good. So it's 56% up. So so in the mutual fund, since we talked about the country biases, you don't want to invest your fund just on the Canadian index. You want to diversify as much as possible. Therefore, you not only invest in Canadian index, but also some like your money in US. I picked US index because by combining Canada and US, you pretty much kind of like you are almost diversified to most already. I don't think so. You need more diversification. So therefore, I'm just suggesting Canadian index and US index and US total market index. So that should cover the entire US. So the split should be 15% for VCE and 85% for VUN. Only reason is number of stocks in VUN is I think it's like 4,000 companies versus VCE maybe like very very less compared to VUN. Again, coming back to this thing, right? Like the total Canada index is just 2.7 trillion, whereas like the US market is like 45 trillion. So there's no comparison, right? So therefore, it makes sense for you to have larger exposure to US. That way, you get even more diversified. So that's for the conservative.